Hi, my name is Rajiv Rubello, and I'm the principal and actuary of Colva Insurance Services. This is the second video in our series of how choosing the wrong life insurance policy can be a $21,000 mistake. In this video, we'll cover life insurance basics, like the pros and cons of term and permanent insurance, and I'll be using my experience of having worked as an actuary for the pricing department of a large life insurance company in order to describe how life insurance works, who needs life insurance, and the key risks to consider prior to purchasing a policy. So let's quickly go over my experience working in the life insurance industry and how I came about the knowledge I'll be sharing with you today. As I mentioned, I'm a certified actuary, and for those who don't know what an actuary is a financial professional who helps make insurance companies profitable by using math, statistics, and complex financial modeling. I started my corporate career as an actuary at New York Life, where I supported the pricing and design of life insurance products and illustration systems. It was here that we studied statistics regarding the percentage of policyholders that die in a given year, as well as the percent that end up canceling their policies. Based on these statistics, we designed life insurance policies and figured out how much to charge policyholders for their policies in order to make the life insurance products profitable for the life insurance company. I then built on this experience by working within an investment and insurance unit of AIG, where I helped to manage a $4 billion portfolio of over 6,000 life insurance policies. My primary goal here was to figure out the minimum premium to pay on these policies while still maximizing the death benefit received for various investors. Throughout the course of this presentation, I'm going to be drawing on the knowledge I obtained from my life insurance experience in these roles to help you make better decisions with regards to your own life insurance policies. Life insurance is a type of insurance product whereby the policyholder pays a premium to the insurance company for a certain number of years, and the insurance company agrees to pay a death benefit if the insured dies within the contractual time frame. As we saw in the first video of this series, the purpose of life insurance is to protect the insured's family against future liabilities that would not be met if the insured were to pass away. If the insured dies within the contractual time period, the insurance company pays the beneficiary of the policy, usually a spouse, child, or other family member, the death benefit on the policy. So who actually needs life insurance? There are three main groups of people who can benefit from purchasing a life insurance policy. The first are people who financially support dependents, who would suffer an economic loss if that individual were to die. Usually these dependents are spouses or children who depend on that insured's income. The second group of people are individuals who are looking to avoid the estate tax. The estate tax is a tax levied on the estates of individuals when they die. Currently, the 2012 estate tax rate is 35%, above 5.12 million. However, in 2013, the estate tax is scheduled to increase to 55%, above 1 million. What that would mean is if that you have a net worth of above 1 million and die in 2013 or later, every dollar above that limit would be taxed at 55% prior to your beneficiaries receiving it. The death benefit proceeds of a life insurance policy, however, are tax-free. For these reasons, people with high net worths often purchase large life insurance policies simply to be able to pass on their wealth to their heirs without facing these high tax charges. The third group of people who own life insurance are individuals and corporations looking to use life insurance as an investment in order to gain safe, long-term, after-tax returns. In fact, some of the largest assets on the balance sheets of banks such as Bank of America, Chase, Wachovia, etc. are life insurance policies. In 2011, banks had over $123 billion worth of life insurance on their balance sheets. So who doesn't need life insurance? People who don't need life insurance are primarily people without financial dependence, significant assets, or a need for a long-term return. So for example, if you're a retired couple who won't be subject to the estate tax and aren't actively supporting financial dependence, life insurance is not going to be particularly desirable for you. So let's go ahead and talk about the risks policyholders face when purchasing a life insurance policy. There are two main risks to take into consideration. The first is buying a long-term policy for short-term needs. So for example, if you're almost ready to retire with 2 kids in college and just want to protect your kids until they graduate, it doesn't really make sense to get a 30-year term policy because you just end up spending thousands more in premiums for extra coverage that you don't really need. As we saw in the first video in this series, this problem is compounded if you then end up canceling the policy after a few years, since what you end up doing in these cases is essentially paying the more expensive premium while only receiving the cheaper and shorter life insurance coverage from the carrier. The other risk to take into consideration is buying a short-term policy for long-term needs. So if you are just starting a family and have a house to pay for and retirement expenses to fund, it doesn't really make sense to get a 10-year term policy, because if you die after 10 years, your family would still have mortgage and retirement liabilities that would leave your family unprotected. Now let's move on to talking about the two main types of life insurance, which are term insurance and permanent insurance. With term insurance, you purchase coverage for a set period of time and pay premiums each year. If you die within that set period, your beneficiary gets a death benefit. Otherwise, they receive nothing. This type of insurance is purely for protection purposes and is often referred to as renter's insurance because you generally only need the insurance for a short period of time. The types of term insurance are generally 10-year term, 20-year term, and 30-year term, although intermediary terms can also be purchased. The pros of term insurance are, of course, that it's relatively cheap and you can choose the period that best matches your needs. The cons are that there's no death benefit if you die after the set period, and you don't receive any money back if you end up living to the end of the coverage period. It's ideally designed for people with short-term insurance needs and those who want more liquid investments. The second type of insurance is called permanent insurance, and it combines life insurance and investments. The purchase coverage lasts for the lifetime of the insured, and the premiums paid on the policy go towards two components. The first is towards life insurance expenses, just like the term policy, and the second is towards a tax-deferred cash value account that you can think of as similar to a 401k. As long as this cash value account is positive, the policy stays in force. Permanent insurance is often referred to as buyer's insurance because just like a house, you're willing to pay more for it up front because you plan on keeping it for a longer period and also want to benefit from the equity appreciation over time. The three main types of permanent insurance are whole life, universal life, and variable universal life. These three offer various levels of risk and return, with whole life having a very low risk level, but also a very low return. Universal life also offers low risk, but offers a much higher return than whole life. Variable universal life offers the highest potential return, but also the highest risk because it allows you to invest directly in the stock market. The pros of this type of coverage are that it affords you the ability to have lifetime insurance protection, as well as equity appreciation rates that are greater than what you'd find elsewhere with similar risk. The cons are that just like a house, it has high upfront expenses, as the premiums for these policies in the early years can be 5 to 8 times higher than 30-year term premiums for the same face amount. These types of policies also have high back-end expenses and low liquidity for the first 15 years of investment. In other words, if you try to cancel the policy in the first few years and walk away with your cash value, the life insurance companies will charge you a high cancellation fee, which in most cases will result in you walking away with less money than you actually paid into the investment. It's also important to note that when you die, you only get the death benefit amount of the policy, and not the cash value that has accumulated. There are a couple of key qualities that make people ideally suited for purchasing a permanent life insurance policy. The first is that they have long-term life insurance needs. The second is that they can financially commit to paying the expensive premiums on these policies, at least in the early years, so that they can benefit from the investment side of the policy, as opposed to losing thousands by canceling the policy early and facing the high cancellation fees. The third is that they want to make a play on tax-deferred investment gain and or to avoid estate taxes. Well, that concludes the second video in our 6-part series of how choosing the wrong life insurance policy can be a $21,000 mistake. In the next video, we'll go over the importance of creating a financial plan in order to determine exactly how much life insurance you need, as well as the importance of considering how your needs change and decrease over time. You can find a summary of all 6 videos in the series in the YouTube description below this video.